Welcome to Energy Insights, your source for the latest energy analysis. So, we are entering a period where the global energy markets are shifting rapidly. Crude oil, refined products, natural gas all are reacting to changing demand patterns, policy signals, and supply disruption. In this video, we break down what's really driving these movements and what it means for the global energy outlook. So, today we are covering the energy market shift, tech slowdown, biofuel rise, oil and gas price volatility across the crude and LNG. So this is our today's episode. First, we have to look into our segment one, which is the Tesla battery business, from silent growth engines to sudden slowdown. For years, Tesla quietly built a highly profitable energy storage division, largely overshadowed by its electric vehicle business. While the electric vehicle sales showed us signs of volatility, Tesla's battery segment, particularly grid-scale systems like Megapacks, emerged as a fast-growing, high-margin revenue stream, helping stabilize overall financial performance. This division expanded rapidly through 2024 and 2025, benefiting from the global push towards the renewable energy integration and grid stability. Energy storage deployment surged, and the business became a critical pillar of Tesla's growth narrative, even offsetting weaknesses in its automotive segment. However, early 2026 marks a turning point. The once consistent upward trajectory has unexpectedly stalled, raising concern among analysts and investors. First quarter battery deployments dropped significantly, around 15% year-on-year basis, a sharp contrast to the prior record growth levels. What makes this slowdown particularly notable is its lack of a clear single class. Analysts suggest a mix of structure and short-term factors, increasing price competition, especially from the China's manufacturer, decline average selling price as the market matures, potential project delays and seasonal disruptions, broader uncertainty in the renewable energy investment which directly affect battery demand. Another structural issue is the lumpiness of the large-scale storage projects. Unlike EV sales, battery deployments depend on a few large utility-scale contracts, meaning revenue and volumes can fluctuate sharply from quarter to quarter. Despite the slowdown, the broader context remains important. The global energy storage market is still expanding rapidly, and Tesla retains a strong backlog of projects. The key question now is whether this dip is a temporary disruption or an early signal that even Tesla's most reliable growth engine is entering a more competitive and uncertain phase. So from the electric vehicles and the tech downside performance, now we are looking to segment 2, that's also from the renewable perspective. Biodiesel strategy in the context of Australia, energy security limits and strategic trade-off. The move by the Queensland, Australia to invest in biodiesel is not just an environmental initiative, it is fundamentally a strategic response to energy insecurity and geopolitical risks. The backdrop of a global oil supply disruption triggered by conflict in the Middle East, which has tightened the fuel availability and driven prices sharply higher. At the core of this strategy, a 25 million investment to produce around 20 million liters of biodiesel annually by 2028 using feedstocks like waste oils, vegetable oils, and animal fats. This reflects a broader policy shift, moving from the reliance on imported crude toward localized, diversified fuel production systems. The key features are the energy security or pure decarbonization. While biodiesel is often framed as a low carbon fuel, the primary drive here is energy sovereignty. Australia, like many Asian economies, depends heavily on imported fuels, particularly from the geopolitical sensitive regions. The biodiesel output from this project equals only about 10% of daily oil consumption, highlighting its limited scale. However, its strategic value lies in the buffering supply shocks, not replacing the oil entirely. This aligns with the broader regional trend. Countries are accelerating biodiesel adoption to reduce exposure to the volatile global oil markets rather solely to depend and meet the climate targets. Structural constraints, scale versus impact. This is also one of the key features. Despite strong policy intent, biodiesel faces inherent scalability challenge. Biodiesel currently meet only small fraction of the transport fuel demand globally, around 4%, with the limited upside due to the feedstock and infrastructure constraints. Even in Australia, total biodiesel production capacity remains marginal compared to the fossil fuel consumption. This creates a structure paradox. Biodiesel is strategically critical but quantitatively insufficient. In practical terms, it can stabilize margins and supply at the margin, but cannot substitute large-scale oil dependency, especially in transport heavy economies. Similarly, one feature is the policy signaling and market activation. The Queensland initiative is also a market signal to unlock private investment. Biodiesel industries typically require consistent policy support, mandates, subsidies, blending targets, etc. to scale. Historically, inconsistent policy frameworks have delayed investment in Australia's uh, biodiesel sector. By committing capital, the government attempting to de-risk early stage projects, encourage upstream agriculture participation, and build domestic value chains from feedstock to refining. This is particularly important given Australia already exports a large volumes of potential biofuel feedstock but lacks domestic conversion capacity. Similarly, one other feature is the dual track strategy, biofuels plus fossil expansion. Interestingly, the biodiesel push does not replace fossil fuel development, it complements it. Queensland is simultaneously supporting new oil extraction projects like Taroom Trough. This reflects a pragmatic, all of the above energy strategy where biodiesel provides resilience and diversification. Fossil fuels ensure baseline energy security and scale. Such hybrid strategies are increasingly common as countries navigate the tension between the energy transition goals and immediate supply security needs. One of the last feature is the strategic implication for the global energy markets. So the development carries a broader implications. Biodiesels are re-emerging as a geopolitical hedge, not just a climate tool. Energy transitions are becoming securities driven rather than purely sustainability driven. Countries with strong agriculture bases may gain a competitive advantage in fuel diversification. However, the long-term trajectory remains constrained unless blending mandates are strengthened, supply chains like the feedstock, refining logistics are scaled. Technology improves conservation and conversion efficiency. Overall, the bottom line is that the Queensland's biodiesel investment signals a critical shift. The energy transition is no longer just about clean energy, it is about secure, controllable energy. Biodiesel, while limited in scale, is emerging as a strategic bridge fuel, offering resilience in an increasingly volatile global energy system, but not yet a standalone solution to oil dependency. This concludes our segment 2, and now we are looking to the market, global energy market overview under segment 3 with the crude products and gas dynamics. The latest market data reflect a broader tightening across oil markets, strong momentum in refined products, and a clear regional divergence in gas pricing. Together, these trends reinforce a key structure shift. The global energy system is becoming a more volatile, less synchronized, and increasingly driven by regional fundamentals. In case of the crude oil latest market data, the strong benchmarks being observed. The key crude benchmarks are trading firmly in bullish territory, like the American benchmark WTI crude traded at $92 per barrel, which is an upward moment of 2.8% increase. Similarly, Brent crude also recorded an increase in the price in comparison of yesterday by around 2.9%, and its selling price remained $101 per barrel. Marban crude traded at $101 per barrel, which an upward moment showed 4.9%. Similarly, the OPEC basket also remained slightly weaker trend. It showed a slightly weaker trend and traded at $97 and $98 per barrel. The overall interpretation of the crude market reflects that the move above $100 per barrel confirms a tight global oil balance. Marban outperformance signals strong Asian demand and Middle East supply tightness. The relative softer moment in the OPEC basket suggests internal divergence within the OPEC rates. Overall, the crude markets are tight at the benchmark level, but underlying fundamentals show fragmentation by the grade, geography, and quality. In case of the refined products, demand remains strengthened and supply constraints also being observed. The refined products are rising faster than the crude, highlighting a downstream stress. Gasoline futures traded at $3.30 per gallon, which showed an upward moment with an increase of 2.9% comparison of yesterday price. Similarly, the diesel fuel also showed an upward trend, an increase of 3.5% and traded at $3.86 per gallon. Both the gasoline and diesel are seeing stronger upward price pressure. The higher percentage gains relative to crude indicate tight refining capacity. Diesel strength reflects industrial and freight demand resilience. So the overall market is entering a refining constraint phase where product availability, not crude supply, a driving price escalation effect is. In case of the natural gas and LNG, gas markets show the clearest divergence across regions. Henry Hub traded at $2.07 per MMBTU, which recorded an increase in price 1.8% in comparison of yesterday. Similarly, the Dutch TTF traded at 7.6% increase in its price. And the Japan Korean marker also showed an upward movement with an increase in comparison of yesterday price by around not increase, it's showed a sharp decline, almost 17.6%. So the US market Henry Hub is stable due to strong domestic supply, European tightening due to the supply risk and strong concern, and the Asian is weakness suggests demand softness or temporary oversupply. Gas markets are no longer globally aligned, they are regionally segmented systems with independent pricing dynamics. So bringing all segments together, crude oil remain tight and geopolitically driven, refined products even tighter, driven by capacity constraint, and gas market is diverging sharply by region. This creates a multi-speed energy market where oil sets the global direction, products amplify price pressure, and gas reflects regional imbalances. The current energy market is defined by tight oil, constrained refining, and fragmented gas system. Overall, the global energy system is transitioning from a unified market to fragmented one, and the structure shift is central to understanding the current energy dynamics and will shape investment policy and trade decision going forward. This concludes our today's analysis regarding the latest energy markets updates. Thank you for watching Energy Insights. We will see you in the very next episode.